Okay, so this is a continuation from our last video, number 6, derivatives. This is number 7, trading fees and funding rates of derivatives. It's going to be a short video, some more boring stuff, but it's foundational. And it's important. It's important to know the fees you're going to be dealing with on both or either spot or derivative exchanges using limit and market orders. Market orders are fine, but just know that fees for these order types are usually higher than that of limit orders. Not only are limit orders often cheaper, you can a lot of times actually get paid a rebate instead of actually paying a fee on derivative exchanges. The exchanges do this as an incentive to create a market. These rebates are seen only on derivative exchanges, though. Now, spot exchanges will offer lower trading fees depending on the amount you regularly trade. Most have a tiered fee system, and that's dependent on the dollar amount traded. A side note, though, limit orders can also, not only can they save you on fees, they can also help you with slippage to capture more money from the market in the long run. So I've listed some information on spot exchanges. Let me get to that on that slide on spot exchanges, but most of this video about fees is going to be on derivative exchanges that fall under the following order types: market orders, limit orders, stop market, and stop limit. I'm skipping conditional bracket orders and hidden and icebergs for this video to keep it short and sweet. I'm trying to keep all these videos really just compact, to the point, and not go over all the nuances and so forth. So what are trading fees? Trading fees are just simply the cost associated with executing market trades on either spot or derivative exchange accounts. Fees tend to be higher on spot exchanges such as Coinbase compared to their derivative counterparts. Not only can there be a difference in fees between spot and derivative exchanges, there can also be one with exchanges that belong to the same category. So you can have two different spot exchanges, and they could be vastly different from each other. For instance, Coinbase, everybody knows about their higher fees. They usually have higher fees than a lot of other spot exchanges. So please be aware of this and know what you'll be paying to execute trades on whatever exchange you're using, right? Spot exchanges do list their fees in those structures, and derivatives will have their fees listed within the contract details. Don't forget to check your contracts, not just for fees. You really just you have to know what you're trading, know what asset you are trading. All right, so next slide. Whether spot or derivative, regular trading fees can be categorized as market or limit orders. Limit orders are resting orders on the exchange books and are considered makers because they provide liquidity and make a market. Market orders are considered takers because they take liquidity from the order book on a market. Market fees are generally higher, and like we touched on in the previous slide, limit orders on derivative exchanges are often provided a negative fee, which comes in the form of a rebate. Spot exchange fees are pretty straightforward with maker and taker fees, some higher than others, but they all list their fee structures. Now, limit orders can sometimes be considered makers depending on when they get filled. That's considered a marketable limit order, and I'm not going to cover those at this time. I'll cover them a little bit later. The formula used mostly to calculate fees on a spot exchange is the following: trading fee equals, or filled order quantity times the trading fee rate is your trading fee. All right, here is a chart of just some exchanges, what they currently charge. Of course, the list can update or change. Bybit, their maker fee rate is 0%. Taker fee is 0.10. Let's see, Coinbase, 0.50. for their maker and 0.50 for their taker. So just Coinbase to Bybit, look at that. That's a big difference. Binance is a little bit better. They're definitely better than Coinbase. So with derivative exchanges, there's still a regular maker and taker trading fees, but we also can have extra cost for both perp swaps and regular future contracts. Futures have a fee for settlement, and perps have a funding rate mechanism. All right, let's see here. 31. The funding fee mechanism. We're talking about derivative accounts, derivative exchanges. Funding fee mechanism is used to ensure the derivative price is pegged to the spot price for the underlying asset. Normally, exchanges achieve this using an index pricing marker, or otherwise known as the mark price, to determine whether longs or shorts either pay a fee or get a rebate. The index price is usually an average of the price from two or more spot exchanges that are selected by the operating exchange. Okay, simply put, the funding rate refers to the percent per contract held by the trader and whether they pay a fee or get paid one via a rebate. When perpetual price is higher than the spot price, the funding rate is in a positive state. When funding is positive, traders holding long positions pay the short seller holders. When it is negative, short position holders pay longs. A negative rate will happen when the derivative is trading lower than the spot price. And that rate, it typically occurs every 8 hours. There are some exchanges that are different, but I think for the most part it's every 8 hours. And because it is a dynamic price, it can, or fee rate, it can change every 8 hours as well. That rate, though, is considered neutral when it is 0.01. And here are the fee formula examples. All right, moving on. Here is just another, well, blah, blah, blah. There we go. So these are some fees and funding rate examples from BitMEX for their perp contracts and future contracts. And again, dynamic, they change. Funding rate or interval is every 8 hours. And this was just taken, I think, a few hours ago. So their max leverage is 100x for the XBT perp. Their current maker fee is negative 0.01. Their taker fee is 0.05. And right now, longs were at the time were paying shorts were paying shorts were paying longs. For BitMEX futures, they offered 100x leverage for that XBT 21 contract. Their maker fee was negative 0.01. Their taker was 0.05. But of course, it's a future contract, so that settlement fee can change. Oops, man, I just went way past there, didn't I? All right. Carrying on here. So here are some examples from Bybit. All inverse perp contracts, maker's rebate, negative 0.025 for maker, 0.075 for the taker. .25, 0.75, and Bybit's just, Bybit is one of the cheapest out there. Just one other reason I love them. And I know I'm going to sound like a Bybit shill, but they're just great. I've never had a problem out of them. So in conclusion, know your fees, know what you're dealing with. A lot of times, past couple years, or maybe a couple years ago, there was a time where shorts were just getting paid for months on end. And I actually ended up making a decent amount of money just holding my short. You can get paid on these every 8 hours. Now, you can, to avoid paying the fee, you can close your position seconds before that funding rate, and to avoid the fee. Depending on your position, I wouldn't say just do it for the money. All right, guys. So this is going to be one of the last boring videos. The next video is going to be on risk management. That will conclude. I'm going to skip over more boring stuff to get to actual technical analysis stuff that you can start practicing now. But that will be after the next video, risk management. I'm also uploading one more single strategy for you guys, the 9 and 21 cross. So that way you can continue to try to make some money while you're learning. If anyone picked up that first single strategy, the 21 moving average strategy, man, you could see how it's been doing. I still use it to this day, and it's been just great. All right, so I'll see you guys in the next video.